Hey guys, Marcus Serra here. I've been in the insurance industry for about 6 years now. I've seen a lot of good policies. I've seen a lot of bad policies. We do a lot of policy reviews, and some of the things that I see agents do when it comes to, specifically when it comes to index universal life insurance policies, is it's shocking. You see, the way an index universal life insurance policy is supposed to be designed is typically with minimal death benefits to lower the fees, lower the cost of insurance so that the cash accumulation can build a little faster inside policies. Biggest complaint is people say these IULs are expensive, they have high fees. Well, typically the only time you'll see high fees is if the death benefit is boosted up. Now, why would the death benefit be boosted up, you ask? Some agents are undertrained. They just don't know how to write the policies, or they have a inferior product with an inferior company. The company gives them limited ability to design it specifically the way that it's supposed to be designed. There's a couple companies out there that only allow agents to run it at just a general, what we call target design, which means it's like a 50-50 split between insurance and cash value growth. It's more heavy on the insurance, so higher death benefits, a little less on the growth, although it still does grow cash value. The way that this IUL was designed, it came about many, many years ago, back in the 70s, when a guy named E.F. Hutton, some of you may know him, some of you may have heard of him. E.F. Hutton said, I love the way that investments grow, but I don't like the risk. I like the stability and the guarantees of insurance. And he wanted to marry the two together. And we were introduced to universal insurance. And then shortly after that, index universal insurance. And the way that it was designed was for cash accumulation growth. You're putting money in, you're not investing it, but you're saving it into a policy where it can grow with a conservative interest rate. ULs are fixed interest. It's kind of like a whole life product. Universal life, fixed interest. It does not fluctuate based on the market, but IULs are based on market performance. So you can set your cash value, can be tagged to grow in accordance with whatever indices you peg it to. And there's several, you can mix and match, and you can put it across a couple different ones. The growth happens when the market goes up, yet there's a floor built into the policy. So if the market crashes, your money doesn't go anywhere. It doesn't go down. There's no negative return. Now, in some policies, there are caps. Other policies, there's no caps. So you may be with a carrier that gives you unlimited cap potential, where your policy could get 12, 13, 14%, depending on what the market does. It's an average return over a year, over a 12-month period. But other carriers will give you a cap, so that if the cap is set at 10%, you'll get up to that 10%. The carrier will get the rest. Okay. The way that these policies are supposed to be designed is with minimal death benefits. That's 90% of the time. Lower the death benefits to the legal minimum. The IRS sets certain guidelines that say this policy can have this much insurance and this much premium going in it. If you have too much premium for the amount of insurance in there, it becomes what we call a modified endowment contract. It becomes an investment account, for lack of a better term. And the IRS can tax you on any of the growth. Now, that being said, long story short, a little bit more advanced. You can have a modified endowment contract in a life insurance policy. There's nothing wrong with that. It just depends on how people design it and what their future goal is going to be used for. I know millionaires that'll put a lump sum of money in the policy just to get that money growing tax deferred, but it becomes a modified endowment contract, which means they put more money than the IRS allows based on the level of death benefits in that policy. There's nothing wrong with that. It just depends on your ultimate goal in mind. Most people that have IULs, 98% of the population, should have an IUL built with a low death benefit for higher cash accumulation. Now, let's just say you put in $250, $300, $400, $500 a month, $6,000 per year. Okay. $10 of every $100 that goes in that policy should go to the cost of insurance. Over the lifetime of the policy, the cost will go down as the cash goes up. Why? It's not that the insurance is getting cheaper, because as we get older, insurance gets more expensive, but it's the risk associated with that death benefit that the carrier starts to shift to you versus them keeping. If you have $100,000 in your cash value and you have $200,000 in your death benefit, the carrier is really only going to charge you for the difference of the two. $100,000 death benefit versus the full $200,000 death benefit. That's just typically how these insurance policies work, especially in IULs. Not a lot of people know this. A lot of people say hey, it's built on an annual renewable term and the cost of insurance goes up every single year. Well, they're not 100% wrong. The cost of insurance does go up, but as the cash value grows, it starts to mitigate the risk. It starts to shift the risk over to you as the self-insured party and takes less risk away from the carrier. Therefore, the total cost of insurance ends up going down in the long run. There's a couple different ways that you can design the policies. If you look at your illustration software, you can see usually it's an option A for level death benefits, or it's an option B for increasing death benefits. The only reason you'd want to increase the death benefit is if the candidate was young and they want to put more money in as the years go by. Typically, you want to keep the death benefits level if it's an older client going into a policy so that the cost of insurance stays lower and doesn't increase over time. Okay. You can set these policies to stop at 65 years old and then no more premiums need to go into the policy for the rest of your life. That's typically a paid up policy up to 65, and then you'll have death benefits, living benefits, cash value growth, and accumulation until you're 120 years old. You can also set it up to be a 10 pay where it only is paid in for the first 10 years. You can set up a 20 pay where it's only paid in for the first 20 years and then it stops. Okay. Lots of different ways to skin a cat, right? Lots of different ways to design a policy. If you're interested in learning more about this, if you want to sit with a professional, want to sit with a fiduciary, somebody who is out for your best interest versus the agent's best interest, you're going to want to sit with somebody that knows how to design a policy correctly, lower death benefits, higher cash accumulation, and there's some other intricacies that you can do inside the policy to get the best bang for your buck. With that being said, I have a few resources down in the description. You can click them. You can schedule a free consultation. I'm not a hard sell. I don't twist any arms. I just give you value. And trust me, when you receive the value that I give you, you're going to want to work with me. In the end, as long as you get educated and you make a good financial decision, these products can be a beautiful, beautiful part of your retirement plan. But if you sit with somebody that doesn't know what they're doing, it can be a complete disaster. Guys, my name is Mark Cassara. I've been in the financial services industry for about 6 years now. And I try to make very complicated things easy to understand. If you like this type of content, you want to learn more about money, finances, budgeting, wealth, and other things related to that, make sure you subscribe, make sure you like, make sure you leave a comment, and share this with a friend. I'll see you in the next video. God bless.